Hi all, my name is Glenn Waters and I lead the PwC Raise Ventures team. If after watching this video on market standard for term sheets, you have any questions, here are my contact and LinkedIn details. From experience, one of the most difficult things about the fundraising process for entrepreneurs is getting a term sheet from a VC. It's the holy grail. The term sheet is critical as it usually determines the final structure of an investment. It is not a letter of intent, but a blueprint for your future relationship with your investor. What we often found when talking to both entrepreneurs and investors is that what was considered market was based on personal experience and was highly subjective. As a result, increased transparency in the ecosystem, both for investors and entrepreneurs, we produce an annual independent market report on term sheet terms. The key highlights from the term sheet report I'm about to go through was based on 187 anonymized final term sheets issued in 2020, ranging in investment size from 500,000 to 50 million in both the UK and Europe. These have been categorized as seed, less than 1 million, Series A, 1 to 10 million, Series B, 10 to 30 million, and Series C, 30 million plus. The investment was from a range of investors, including traditional VCs and family offices, as well as EIS and VCT funds that are tax-efficient funds specific to the UK venture ecosystem. I'd personally like to thank Tom Ward from Fieldfisher, Howard Watt from Floodgate, Henry Humphreys from Humphreys Law, Phil Robinson from Ignition Law, David Strong from Marriott Harrison's, Brian Shaw from MBM, Alistair Hamilton from Shoesmiths, and Ian Moore from Taylor Wessing for participating in the survey and helping make it happen once again this year. Okay, I'm now going to go through some of the key highlights of my survey. This recording is not meant to be a detailed technical guide to what these terms mean, which can be a whole nother session if people would like. When looking at a VC term sheet, in our market report, we've looked at it from both an economics and control perspective. So firstly, downside protection. After valuation, which is a whole separate discussion, the most important term in a term sheet is structure, and specifically the liquidation preference. We found that it was market for an investor to have some form of downside protection, with 73% of term sheets having some form of preferred shares. Where there was a preferred share, the market in 71% of cases was non-participating, i.e., this is where an investor has a choice. Their investment money back first, ahead of the other shareholders, or the investor participating as an ordinary shareholder on a pro rata basis. Nearly 30% of deals had a participating structure. This is a double dip when the investor gets their investment amount back first, and in addition, then participates on a pro rata basis on the remaining exit proceeds. So very investor friendly. When we look deeper into the data, the preferred participation was mainly seen in investments from UK tax efficient funds, i.e. those EIS and VCT investors, where downside protection for their retail investors is key, but a money multiple return on their investment could be 3 to 4x, as opposed to 10x, often quoted by traditional VCs. Linked to the liquidation preference is the liquidation multiple, i.e. how many times back the investor gets on their money. For both non-participating and participating, 1x was market. Although some might say outrageously, in 11% of term sheets, there was a participating structure with a 2x or more liquidation multiple. I think the key thing for a founder when it comes to liquidation preferences and multiples is you need to consider it in conjunction with all the other terms. What you really need to do as an entrepreneur and founder is look at the exit waterfall. You might think you own, say, 35% of a business, and this is what you get in your pocket at exit. But in reality, this could be very different depending on the preference stack. And analysing how much you get at various exit stages with different clauses is key. but often a lower valuation of the right structure can lead to better outcomes. Next, option pools. Creating a new or enlarged option pool was seen in 84% of term sheets. In 32% of cases, the option pool was created in the pre-money, and in 47% in the post-money. And in 21%, it was a mixture between both the pre and the post-money. And where an option pool was created, a 10% option pool plus size was the most common. So why is this important for founders? There's something called the option pool shuffle. If the option pool is created in the pre-money, existing shareholders pay for the increase in the option pool, i.e. through dilution. And if it's created in the post-money, the existing shareholders and new investors will pay for the increase. In my view, there's no right or wrong answer regarding the option pool discussion. One could argue that options for existing employees that should have already been rewarded should be out of the pre-money. And for any future hires, this should come out of the post-money. As long as all parties involved are fully transparent and aligned about how the option pool works and whether it is included in the pre-money valuation or not, there's a level playing field to come to a fair deal. Next, economic terms. So 21% of transactions involved tranched investment. In 46% of the term sheets we looked at, we saw an anti-dilution provision. This protects the preferred shareholders by preserving their ownership percentage in the event of a down round. 100% of term sheets included some form of investor consent, while 70% of term sheets included a restrictive covenant post-departure. And where there was a covenant, in 50% of cases, the duration was for a 12-month period. Next, exclusivity. In 79% of term sheets, an exclusivity clause was specified. And where it was specified, between 30 and 60 days was the most common scenario. Fees. 71% of term sheets did not have an investor arrangement fee. In the 29% that did, an arrangement fee between 2 and 3% was seen as market standard. In terms of ongoing monitoring fees, so the pie chart at the bottom, this was seen in 28% of deals, and this was typically based on an annual fee ranging from 20 to 30,000 per annum. Now, if we move on to control. So before we get into some of the findings on control, it's worth pointing out that VC investors are minority investors and therefore often require some form of minority protection. So in terms of board appointments, in 95% of term sheets, the investor had the right to take a board and or observer seat. In 40% of deals, there was a right to appoint both an investor director and non-voting observer. Surprisingly, in nearly 11% of deals, the investor had the right to 2 board seats. In terms of a minimum threshold to hold an investor board seat, this was specified in 31% of term sheets. And where it was specified, 5% of the fully diluted equity can be considered the market standard requirement, although 10% was not uncommon. Leaver provisions. This is a very emotive one for founders, where interestingly, in 36% of term sheets were silent on leaver provisions, and these were negotiated as part of the long-form document after the final term sheet had been signed and the company was in exclusivity with the investor. In the 64% of cases that were specified in the term sheet, there was a requirement for a departing founder to relinquish some, if not all, of their shares, depending on the type of leaver they were, which is the graph on the right-hand side. In terms of founder vesting, so in 58%, 108 term sheets, there was a founder vesting clause. Again, another a very emotive term for founders, where the founder earns their shares back over time. Now, this clause is used by investors to help ensure key founders and management don't leave the business early after an investment has been made. Where vesting was specified in the 108 term sheets, no pre-vesting on day one was the most common scenario in 41% of cases. With 25% or less pre-vested, i.e. already earned on day one, the next most common scenario at 30%. Surprisingly, when we did a deeper dive into the data, the results didn't vary much between seed and Series B. In terms of time to earn these shares back, this was typically over a 3 to 4 year period on a straight line basis. Now moving on to warranty provisions. So if we look at founder and management warranties, what we saw is 77%, so 144 term sheets sampled, had a founder management warranty provision included. In terms of market standard, a 12 to 18 month period with a 1 times multiple of salary was seen as standard. From the company side, in 80% of term sheets sampled, there was a company warranty with a 1x investment over a 12 to 24 month period seen as market standard. Okay, that sums up the key highlights of my term sheet report. I've released the key extracts of the term sheet report on LinkedIn, so you will be able to find articles and commentary there, but please do get in touch if you want to discuss anything in more detail. Thank you very much for watching.